Welcome to the VA Loan Virtual Lunch and Learn. Again, I always start these calls the same way. The purpose of this call is education only. I am not a certified loan originator. If you do have any personal questions about your own financial mortgage situation, please reach out to a loan officer, preferably one that is well versed in all things VA loan related. Again, this is not a call to request or solicit business of any kind, and any professionals in the real estate community that I see on the call potentially trying to get business out of any veterans that are also on the call will be asked to leave. And in the end, all things VA loan related need to be go by what's called the VA loan handbook. And so you can either follow that website address or you can scan that QR code down there, and that'll actually take you to the VA loan handbook. Now, the thing about the VA loan handbook is it's very black and white, and the VA loan oftentimes operates in gray, which is actually a good thing. It means that more lenders can do their job and get more veterans into homes. So what is the purpose of the VA loan? Well, to be honest, there really isn't an official one, but for me, it is to give every man and woman that serves this country the lowest barrier to entry possible in owning a piece of it. And that phrase, lowest barrier to entry, is what I want everybody on these calls to understand. There are several barriers to entry when it comes to homeownership. Down payment's one of them. The VA loan is a zero down home loan. Monthly payment is another one. The VA loan has no PMI, which does a really good job of offsetting the cost as opposed to other mortgage products. Thirdly, there is no real debt to income ratio requirements. It's actually, they go by what's called residual income. But those are just three examples that make it the lowest barrier to entry. Now, having said that, only about 33% of the veteran community actually use their VA loan. And that's due to a number of reasons. One of those is that don't even know that it exists. Of the ones that never use it, half don't even know that it exists. And again, I say this all the time, there is a very underwhelming, I will say, process when it comes to transitioning from a soldier or airman or Navy, active duty, Marine to civilian life. And they just simply aren't told the information correctly. Now, that's on the DoD, but it's also on the real estate professional community to have better conversations out there, and not only the veteran community, but the active duty community. And this is the one that I really, really, really hate to say it out loud, but it's true. So we're not going to shy away from it. The half that does know about the VA loan but doesn't use it, they decided that because a real estate professional told them not to, or they were given bad information, maybe amongst their peers. But the point is that conversations and calls like this will change that stat, and we can get more and more veterans into homes by conversations like this. So today's topic we're going to go over is the IRRRL, or interest rate reduction refinance loan, and concessions versus closing costs. And these are two things that really do make the VA loan one of the best home buying products out there that there is. So it's very important that we talk about them and we are able to convey them in a intelligent and concise way. And then the last thing we're going to talk about is a cool little wealth building strategy that I like to call the 20-year veteran millionaire. So there are actually two refinance products involved with the VA loan. Now, I operate out of Texas. In Texas, we do not have the cash out refinance option. So we're going to stay away from that because I am not familiar with it as much as I would need to be in order to talk intelligently about it. But maybe we'll have a loan officer from another state that does these cash out refinances come on one day, and so we can go into that. But the other one is the interest rate reduction refinance loan, and that is the one that we're going to talk about today. So first thing about the IRRRL: veterans, spouses of veterans, family members of veterans, active duty. Once interest rates go down just a wee bit, and it's the 7th month of your mortgage payment, you're going to be getting all kinds of these things in your mailbox, and they are garbage. throw them away immediately. Do not call the numbers associated with them. Very similar to a certain mortgage company that rhymes with Smithsnider and Smoothsnited, these companies have what I call a throw spaghetti at the wall and sees what sticks approach when it comes to marketing. So you call that number, and they have a lot of really bad misinformation on there. Number one, they usually say something like get 2 mortgage payments, or they usually say something like cash back at close. And we'll go into why those are two very deceptive things. So long story short, you're going to get all kinds of stuff like this. And it's going to even say like, it's going to look official. It's going to look like it's from the VA. They're very good at this, unfortunately. Just please throw it away and contact the person who originally serviced your loan if you want to look into refinancing, or shop around to somebody else that you've met that you feel comfortable with. Point is, don't take the bait with these creepy mail out IRRL postcards. So the interest rate reduction refinance loan, otherwise known as the IRRRL, you'll hear it talked about a lot like that in the veteran community, or it's also known as the VA streamlined refinance. And why it's known as that is because it allows a homeowner with a current VA loan to refinance in one of the quickest and most efficient ways possible. Now, the important part of that statement there is with a current VA loan. If a veteran for some reason has a conventional loan or an FHA loan, they cannot refinance using the IRRRL. They can refinance to a traditional VA and then have access to this IRRRL benefit, which again, don't FHA my VA, don't conventional my VA. There is so many reasons why the VA loan is a superior loan product for our veteran and active duty military home buyers. But anyways, why is it one of the most quickest and most efficient ways possible to refinance? Well, there's no appraisal involved. There's no income verification required. I've seen them close in as fast as 2 weeks, probably even faster. And all the costs to refinance can actually be rolled into the loan. And that's really, really important. And we'll talk about what that actually looks like. Things such as like normal discount points can be rolled into the loan. Things such as there's even a way to refinance and roll in energy efficient appliances and upgrades into the refinance. So I don't want to go too much into the weeds on that. I just want everyone on this call and paying attention to have a basic overview of what this loan product is, or this refinance product is, and how we can talk about it amongst the veteran community and the real estate professional community. So there's a couple things to stipulations, I guess you could say. So for the most part, the monthly payment must decrease. However, there are exceptions to this as well. So a lot of times you can refinance from a 15-year mortgage to a 30-year mortgage to a 15-year mortgage. Obviously, the way the amortization schedule works on that, the 15-year mortgage is going to be a higher mortgage payment. So there are limits as how much it can increase. Again, I don't want to go too much into the weeds, but just know that for the most part, which is like 99.999% of the time, the mortgage payment must decrease by a certain amount. And additionally, the homeowner must sign a statement showing that they've seen the cost breakdown of their current mortgage payment and the new one. And they also must understand what's called the recoup period. And what that is the total time in monthly payments it takes for them to recoup the cost of what it costs them to refinance. And so, and generally speaking, again, there's really no official thing on here. In fact, the VA loan handbook has an example where it takes a veteran 100 months to recoup the cost. Now, that's terrible, but the fact that it's in the VA loan handbook means that it's technically possible, but I would say that reasonable in most cases, in most underwriters, is going to be 36 months or less. So just as long as you can recoup the cost that it costs the veteran or active duty to recoup those costs in 36 months, you're good. So great example. Let's say it costs them $3,600 in closing costs to refinance. Well, the mortgage payment needs to be reduced by at least $100 a month, so that way they can recoup all those costs in 36 months. The interest rate must also be reduced by a reasonable amount. And again, there's a little gray area here because if you're refinancing from an adjustable rate to a 30-year fixed, your rate's probably going to go up a little bit. And if you're adjusting or refinancing from a 15-year to a longer mortgage, your rate's probably going to go up a little bit. So Again, those are one-off 99.9% of the time. The interest rate will be reduced by a reasonable amount, and usually that is about a 0.5% of the mortgage. So if they're at 6.5, they need to have the new mortgage interest rate be at a 6.0. Last thing on there is that the max term that the homeowner can refinance to is 10 years plus 10 years and 32 days plus the original loan term. So the example below you can see is that they had a 15-year original loan term, not like how many years left they have on it. If the original loan term was 15 years, the maximum amount they can refinance to is 25 years and 32 days, but that's 25 years. So a couple things to be aware of, and this is where we're going to go into busting these myths that you will see on these postcards that are very nefarious in nature. There is no such thing as skipping 2 mortgage payments. So just like any close on a real estate asset, the month that you close in, you pay what's called prepaid interest and prepaid insurance and prepaid property taxes, meaning the interest and the all that stuff, you put money into the escrow account, or you paid them up front. Now, every mortgage payment that you pay is the 30 days prior, and then you make the payment on the 1st. So in theory, you're not skipping 2 mortgage payments. It's just the same as it normally would be. But on paper, it can seem like you are skipping 2 mortgage payments, because if you were to close that loan in the middle of July, you will have paid prepaid interest in taxes and insurance for 15 days in July, and then you will pay your first mortgage payment on September 1st for the entire month of August. So it's important to understand how that actually works out, because that's a very big myth, and it's a very big advertising tool that these unfortunate, whatever you want to call them, refinance companies will use. And again, we want to be giving accurate information out there. Again, there's also the cashback at closing myth. You'll see they'll do an analysis, and they'll try and like call it something weird, but they'll try and tell you that you're going to get a refund of all of your escrow. Well, okay, yes, you will see a refund check from the previous mortgage servicer mailed out to you a certain amount of days after close. This is not cash back at close. There is a VA cash out refinance where you can get that, not in Texas, but the interest rate reduction refinance loan specifically says that you are not allowed to receive cash back. Now, there are some certain instances where if there's a calculation error or there's a mishap, or maybe you're using the energy efficient loan refinance and they do want to give you money to go buy your own appliances, maybe. Again, those are one-offs. There is no such thing as cash back in an IRRRL. Now, additionally, what you need to do and understand with that escrow refund, what it is that is all the escrowed money that you've been paying year to date, taxes and insurance, in one check. Now, your lender does a very good job of putting like a 3-month cushion into your new escrow account, and those are again those closing costs. Now, the problem is that's not going to be enough once your property taxes are due, and that new escrow account is going to be deficient in the amount of money that it needs, and your mortgage payment's going to go up the next year. So I'm not going to tell anybody what to do with their money, but my advice to anybody that receives that refinances and receives the escrow refund is just go ahead and deposit that money right back into your escrow account. It's always good to have a buffer. It's a great way of keeping your mortgage payment from going up year over year, and it's just always a good cushion to have. So again, there's no such thing as cash back on an IRRRL. Again, you must have completed the 6 mortgage payments in order to refinance, pretty much across the board for most mortgages. You do not have to be occupying the property. So just because you have bought another property and are renting out the first one, as long as it's a VA loan, you can use the IRRRL to continuously reduce that mortgage payment over time. You just have to make sure that you can show that you at one point occupied it with the VA loan you did. And this is another misconception, entitlement. So the entitlement that you use that is tied up on that property is the same as what you bought it for, meaning, or what the original loan amount was. Meaning, if you bought a property at 250,000 and you had paid the mortgage down for, let's say, 5 years, and now the current mortgage is like 225, and you refinance, and the new mortgage total is like 230. Let's just say that. The entitlement tied up into that home is still 250,000. It doesn't mean you automatically have 20,000 more dollars of entitlement because you refinance into a lower amount. So that's a very big misconception when it comes to entitlement and refinances. So we covered a lot there. We're going to keep powering through to the next topic. Again, I just want to make sure that we're all able to have intelligent conversations about stuff like this. But anyways, let's keep going. So let's talk about seller concessions. So there's a big misconception of concessions and how much the VA loan allows, and it's considered inferior, and sometimes the seller has to pay for certain things, and we're going to dispel all those right now. So seller concessions. So the VA loan actually considers concessions and closing costs two separate things, essentially. So let's talk about concessions first. So there is a 4% cap on what they consider concessions. Now, here's the thing about concessions, and we'll get into the next slide too, is that all the normal closing cost things is not considered a concession in the eyes of the VA. So what is considered a concession? Well, the funding fee. If the seller wants to pay the VA buyer's funding fee of 2.15% on the first use, and maybe they don't have one if they're exempt, but that would be considered a concession. Prepayment of taxes and insurance. Payment of extra discount points. Now, extra is a very important word there because, as we'll see, certain discount points are actually considered closing costs. But anything exorbitant would be considered a concession. A temporary interest rate buy down would be considered a concession. Paying off the VA buyer's debt, which is actually really awesome. This is a loan product where it'll allow, in order to get the deal done, it will allow the seller to pay off a credit card in order for the veteran's credit score to be at where it needs to be to qualify for the mortgage. It's really cool. And then gifts such as like a refrigerator, television, things like that are considered concessions. Now let's compare that to the other loan programs out there. So FHA max concessions is 6%. Conventional max concessions is 2 to 6%, and USDA max concessions is also 6%. Now again, on paper, it looks like the VA loan is inferior as far as concessions. However, there's a whole other section of what a seller can pay for that the VA considers closing costs. Now, what are closing costs? Basically, everything else that's involved with buying the home, which we'll get into in a minute. What are closing costs? So, market determined normal discount points. So, if it's normal in the current market for somebody to use 2 discount points to get to a certain amount of an interest rate, then that is considered normal, and that is considered a closing cost. Title policy, survey, prepaids, appraisals, lender fees, all those things that are normally considered closing costs is basically unlimited as to what the seller can pay for. So, and that really means unlimited. So if the closing costs are $23,000 and the seller wanted to give $35,000, well, the 4% doesn't start factoring in until $23,000 of that. So you can see how it gets way higher than 6% sometimes, if you can negotiate correctly. And guys, let's be honest, we are in a buyer-friendly market currently, and concessions are out there. So make sure you go contact a trusted real estate professional to negotiate on your behalf. So let's talk about a couple of strategies when it comes to IRRL and closing costs. So pairing up a temporary interest rate buy down with the ability of a veteran to refinance so easily is a great strategy to help somebody get their mortgage payment down, their interest rate in the first 2 years down into the 5s in this current rate or the current environment. And then by the end of year 2, nothing's guaranteed, but you can still use the IRRRL and reduce your mortgage payment by refinancing to a 30-year when you're 2 years in. Again, great strategy right now. you should be pairing up temporary rate buy downs with all your deals. So make sure you ask your real estate professional if we can do that. Number two, a great strategy. Like I said, one of the things that's included in concessions is the ability to pay down debt. And so use that to your advantage. If you have an extra $3,000 or $4,000 in concessions and you're thinking about using it to buy down your interest rate permanently a little bit more. Now, here's the thing. The way discount points work, the more you use, the less return on your investment there is. And so for the same $3,000, you're going to maybe reduce your mortgage payment about $40 a month. So it's going to give you maybe an eighth of a percentage point of interest rate decrease. Now, what if that veteran or that person owed $3,000 of a car payment, and their car payment is $300 a month? I don't know about you, but I would much rather have $300 a month less in debt than an additional $40 a month in a mortgage payment. So just make sure, as real estate professionals, as veterans, as consumers, that we're having these conversations and you're having somebody go over these fee sheets and these loan estimates with you so we can do what's best for you in your actual situation. No questions. All right, so I know I promised you going forward, we're going to do first half of the call is going to end up being like techniques, as in like the actual technical procedures involved in the VA loan. And then the second half, I'm going to get into some strategies or tactics on how a veteran or active duty can use the VA loan to really benefit their wealth picture. And I always say it, I'm never going to stop. Y'all, we're in the veteran community. We need to rethink these VA loan benefits. There is nothing better than creating wealth at a zero down. I'm telling you, it's phenomenal. It's the best way of using this benefit, and it is the most easiest and surefire way to build generational wealth. And so today we're going to talk about a strategy that I like to call the 20-year veteran millionaire. So this strategy involves 4 assumptions. Number one, we're going to be buying 3 properties over the course of this 20-year period. Number two, this is the entire period of this process is 20 years. Number 3, we are going to assume a 6% interest rate in perpetuity. And number 4, we're going to assume a 4% appreciation on the property year over year. Now, standard appreciation is usually closer to 5, but I want to go ahead and be conservative on these numbers and make sure that they are accurate and as easy to understand as possible. So these are the 3 properties that this veteran is going to purchase. In year 1, he's a, terminal, just got out, 22-year-old E4 get hot Marine veteran, and he buys his first home. It's a $300,000 home. By year 5, he has now built a family, and so that first home is no longer feasible and needs an extra room. So now he's buying a $450,000 home. And year 10, family's growing, it's time to upgrade again. And the way he's going to do this is with bonus entitlement, and we're going to use what's called the one-time restoration of entitlement, which I dove into deep on another video. Just look it up on the YouTube page. It's the deep dive into entitlement episode. It's really awesome. So these are the 3 properties that he's going to buy. Let's talk about property number 1. Okay, so property number 1, the original price was $300,000. We are now at year 20. So at year 20, through standard 4% year-over-year appreciation, this property is now worth $657,000. Now, through the power of principal paydown, his mortgage on that, the current balance, is $162,000. So if you subtract the mortgage balance from the current value, you have $495,000 in equity from that first property that veteran bought 20 years ago. Property number 2, remember the original price was $450,000. Through 4% year-over-year appreciation, which is provable by a normal curve of appreciation. By year 15 of ownership, because remember, he bought this property year 5, and so he's now owned it for 15 years. The property is now worth $810,000, and through the mortgage principal pay down, he only owes $320,000 on the mortgage. Subtract the two, all of a sudden in his second property in year 20, they have $490,000 of equity in just the second property alone. But because you're a smart veteran and you listen to people that know what they're talking about, you understand that you're not done buying zero down properties just because you bought 2. You have what's called a one-time restoration of entitlement. So property number 3, again, this is year 10. His family has grown. He needs a bigger home. The original price of that property was $600,000, and that was the year 10 purchase. Now, he's owned this property for 10 years as well. So the year 10, meaning by the time he's owned that property for 10 years, it has now appreciated to $880,000. The mortgage that he's been paying on that $600,000 property is now down to $502,000. So do the math. In 10 years of home ownership on the third property, he now owns $386,000 in equity on that property. So that's the scenario. Now let's do the numbers, combine them, and show you how this all works. So here's the equity equation, or the equity situation that this veteran is currently in. Property number 1, he has $495,000 of equity in. Property number 2, he has $490,000 of equity. Now you can already see we're getting really close to $1 million of equity. And then boom, property number 3 comes in where he has $386,000 of equity in that. Add up all this equity combined, and in 20 years, by this veteran buying 3 properties, renting out the first 2, or he doesn't even have to rent them out. He can give them to family to live in. He can let his mother-in-law live in one. It doesn't matter. The point is that the mortgage is getting paid down on all 3 properties, and all 3 are appreciating in value. And over the course of 20 years, this veteran now has $1,371,000 to their name of net worth. Underline that twice, exclamation mark, all that stuff. That is literally the power of the VA loan, guys, and why I always say rethink those VA loan benefits. They have one of the best ways, it's one of the best ways that we can change our financial situation as both veterans and active duty. And it really is a game changer. And that's why I say to this day that the VA loan is the best benefit that we earn. And that's all I have for everyone today. I really like doing these. I really like the techniques version and then the tactical version. And we're going to continue to do these every other Thursday, and we're going to put the information out there. So I would love it if you watched this video and got something out of it, you wanted to share it with another veteran or another real estate professional, because again, the more conversations like this we can have, the more veterans we can not only put into homes, we can actually turn into wealth builders. So that's all for me, guys. Peace out.